This is Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkel.
Welcome back to Inside the Wolf's Den with your hosts, Shawn and Joni Wolfswinkel. Today we have a special guest with us, Satch Bernhardt. How are you, Satch?
Good. Thank you for having me, guys.
Absolutely. So thank you for joining us today. So today we're going to be talking about real estate investing and financial security for pilots and professionals. So a quick bio on Satch. So Satch is a real estate investor and former airline pilot for a U.S. carrier. He began his real estate career by flipping houses in 2018. He grew that company to 31 team members and was then able to step out of the day-to-day operations to begin his real estate private equity firm that focuses on multifamily apartment complexes. His flying career ended when his airline shut down in the middle of the pandemic in 2020. This is a turning point in his mission with real estate. He realized how fragile airline careers are, and he wants to help as many pilots as possible to get financial security through real estate. Again, Satch, thank you for joining us. I'm actually really excited to kind of get into this topic and your background and how you got into real estate. So why don't you kind of take us back?
Yeah, for sure. So I never even thought about being in real estate actively doing deals and stuff like that, or even being a business owner at all, right? Many people are shocked because it's like, well, why did you go that far, right, in business? But all I wanted to do was be an airline pilot since I was a little kid. I don't even know why. Don't ask me why. I don't have any relatives that fly or fly for the airlines. It's just something that since you're a little kid, right? That's what I want to do. And I was passionate. Every time we travel and went somewhere in a plane, I will stop by the cockpit and I just looked at the cockpit, fascinated, right, about all the buttons and everything. And I asked, like every other kid, tons of questions before they kicked me out of the plane. So I finished high school. I didn't even want to go to college. I said, I know I want to fly, and I grew up in Mexico, so I came to Florida to learn how to fly. And when I was 21, I became an airline pilot. And a few years into my airline career, talking to other peers who had been flying for the airlines for 30, 40 years, they will tell me stories of how, the common joke between pilots is you're not a real airline pilot until you've been furloughed 3 times and divorced twice. Oh. So the divorce thing aside, at least the furloughed 3 times was a common theme between pilots, right?
Wow.
And so I started noticing that, and I said, I really need to do something so that if I do get furloughed or something happens to my airline career, I have something else to fall back on. Mm-hmm. And that's what led me down to being actively involved in real estate. I wasn't quite sure what I wanted to do in real estate, but I started, like everybody, right, doing some research. I read the book Rich Dad, Poor Dad, and that just opened my mind to all the possibilities. I started going to local RIA, networking with people, and then I figured out that there was this thing called wholesaling, right? Mm-hmm. And I said, what? I'm gonna give this a try. And so I started wholesaling, and I took it from there, right? At the time I was 25, and this is in 2018. So I started learning my lessons, failing my way forward, growing the team. In 2020, my airline shuts down. During the pandemic, they couldn't. I don't know if you guys remember. Nobody traveled anywhere, right? So airlines got hit pretty hard, and mine couldn't sustain the current environment. The environment back in 2020. So they ended up shutting down. And at the time, I didn't care because I was making enough money with my real estate that to me was like whatever, But I looked around and I saw my colleagues that were pilots there, and they were all really struggling, right? They were stressed. They didn't know where the next paycheck was going to come from. And because when one airline gets hit is most of the time, like during the pandemic, we shut down, but also nobody else is hiring, right? Mm-hmm. So the only skill they knew how to do was fly an airplane, and they had nothing else to do in the meantime. So they were really struggling, right? And that's what opened my mind to, hey, I can really open this private equity firm and help a lot of pilots. A lot of them have zero desire to be actively involved in real estate, right? They will rather, hey man, I enjoy my days off. As pilots, we get many days off, and they say, hey, here's my money. Give me some cash flow, right?
Right.
And so that's what led me down the path of using that. And I started first investing in multifamily. We can break all that down, right? But I started first investing in multifamily for myself. And then is when I realized, hey, I can use this vehicle also for other people.
Right.
Now, my mom invests with me, my father-in-law. I mean, that's quite the trust, right? If
Yeah.
your father invests with you, I should really listen to your father-in-law's money, man.
That's amazing.
That's
I love the story.
Yeah. Are you still, do you still get to fly a lot today, or do you do you privately?
Yeah.
Yeah.
So, yeah, that's a great question. So I actually, once we shut down, that was back in 2020. I took the following 3 years to just continue working on the business. And I recently went back to flying back in May.
Yeah.
So it's very new. And we can talk about this, right? But from a lifestyle perspective, I sat back and I really took a look at my life, and I said, well, how do I want my life to look like? What do I really enjoy doing? What do I have a passion for doing? And I ended up shutting down the wholesaling house flipping business and only focus in the private equity firm and went back to flying. And so I'm doing that now as well. Yeah. And it's been pretty recent. So I took the past 3 years without flying.
Wow.
That's awesome.
I could totally see that, because I mean, the common friend that we have that introduced us, we're really good friends with him. We've watched his career over the years and, traveled with him and all that. And it's really cool. And I always joke around that, like, I want my kids to become like an attorney or a pilot, right? Because the lifestyle they can have is pretty, I mean, you think about it, I can see where you can have your private equity firm and all that, but yet still
build something else
or a pilot, so that you can have that freedom to. There's a lot of perks you get with. I mean, you only have to. You can get it to, depending on how senior you are, but you can get it to where you're like, flying 3-4 days a month or maybe a couple days a week. I don't know. Yeah, I don't know exactly, but it just seems like you can have a pretty good lifestyle. You get the perks of free travel, all that, which I'm sure you get to take advantage of. And so it's an awesome way to. Yeah.
We actually have a flight attendant friend that's pretty good friends with us as well. And he invests in real estate.
Does the same thing.
He does the same thing. Yep. Yeah. That's really cool.
Yeah. It's funny because you will think, okay, pilots make a lot of money, right? But you will not believe how it's so divided, the amount of pilots that are heavily into investing versus that want nothing to do with investing or taking any sort of like financial responsibility.
Right.
I think it's mostly because we have so many days off that they get all this money and they just want to go and like they buy all the toys, they buy jet skis, boat, the thing, because what do you do when you have nothing else to do, right? If you don't have the discipline to go and invest and do the right things, you're just going to go and spend it. Yeah. And it's so funny to see that. It's very 50-50.
Yeah. I mean, if you could change their mindset to like, hey, all that time off, put into something productive. Right. Like you're saying, like another business or an opportunity. And it doesn't have to be full time, but man, you can double down and anyways, but we think like that.
Yeah.
But then
not everybody does though.
I can sure they see the fun part of it.
Yeah. Satch, we kind of want to talk about moving into the single family, the flipping houses to the multifamily syndications. Like what prompted kind of that shift and how did you go about that?
Yeah. What prompted the shift was actually me using multifamily syndications as a service for myself. I doing the wholesaling and house flipping. A lot of the properties that we acquired were from landlords that wanted to give it a shot at owning rentals, and they just got fed up with it. And I don't want to generalize and say all of them turn out to be that way, but I saw the difficulties of owning a single dwelling here and then one other, all sort of like spread apart, right? And my neighbor has 63 single family homes, and I saw how he was running around. Even though he had a property management company managing all the single family homes he had, he still was very involved going to the properties and like taking calls from the property company, making decisions, things like that. So that just kind of made me realize that I don't want to own any single family homes myself. And I started doing some research, and that led me down to multifamily syndications. And I figured, hey, I can invest passively as a limited partner in some of these. And so I started putting money in syndications. I'll put together 50 grand, 100 grand, and I will throw with different sponsors, different type of deals. And then that's what just got me into moving into that space eventually.
Yeah. So do you think, say, we have a lot of listeners in the show that are maybe just starting out and maybe thinking, all right, should I go the single family route or should I go the multifamily route? Do you think they have to get into the single family to kind of understand the multifamily route and or can they just go straight into multifamily?
No, you can go straight into multifamily. I think it's a nice segue to go from single family to then jumping into multifamily, but I don't think there's really a necessity, right? Like I could look back and think, oh, okay, well, I understand a lot of aspects of multifamily when I started wanting to invest in syndications because I knew how to tell if the rehab budget that we had planned for the value add was reasonable or not based on my previous experience doing flips. But that doesn't mean you cannot learn that while like getting involved with other guys doing multifamily, right? So I don't think it's a necessary thing. Yeah.
Awesome.
And although one thing I will say, I mean, a lot of times people ask me if I think multifamily is better than single family. And I don't personally think that. I think it's just whatever your goals are, right? It was something that fit my lifestyle and what I wanted to do. That's why I went that route. But that doesn't mean everybody should follow that route. Right? Everybody should align with whatever their goals are and what they want to do.
Love it.
Yeah. I know you've participated as a co-GP, on several deals, but then you're also a limited partner. Can you explain like the difference between those two and maybe just so listeners can get the understanding of, and maybe they just want to be a limited partner, right? And just they're professionals. They just want to invest in, they don't have to be active day to day just to own multifamily property, right? They can invest in it, diversify. And if they want to take the next step of being a, co-GP and finding the deal and raising the money and doing all they can. But can you explain, I guess, that process a little bit? And
Yeah, absolutely. So from like a 30,000 foot view, all syndications are divided into GP, the general partners, and the LP, the limited partners. Limited partners are the ones that invest in the deal and they put most of the capital required for a multifamily or for a syndication, but they have no active role in the day-to-day operations. And the general partners are the ones that will do essentially everything else, right? From finding the deal, putting all the paperwork together, raising the capital from the limited partners, managing the assets, doing the refinance or selling of the property whenever it's necessary, putting all the business plan together. So essentially doing all the work. And within that general partnership, the limited partners, there's really not much flexibility as to what you can do. All you can really do as a limited partner is invest, and that's it, right? There's nothing else. There's no other ways you can add more value to the property or to the operation other than just bringing in your money. Obviously, the perks are that you don't have to do anything at all, and you're going to get, depending on the strategy, you're going to get possibly cash flow distributions and then and a return on your money, right? So general partner, there's a lot of different things you can do to add more value to the partnership and obviously get equity in the deal for the things you're doing, right? So the thing you mentioned, the most common thing for many people starting off is raising capital. And so you can become a co-GP like I am by raising capital and then doing other things like visiting the property, ensuring that the business plan is being implemented according to the plan. And another way you can do it, and I don't know how deep you want to get into this, but one thing to be aware of if you want to raise capital is that you can't just raise capital and get compensated for it, right? So as a co-GP, I have other duties in that property, right? Or the properties. I raise a portion of the capital required, but I'm also visiting the property, like I said, ensuring that the business plan is being implemented. I'm on the weekly calls with the property management company, tracking KPIs, ensuring that everything is going well, any issues that arise.
And you usually also sign, right, on the loan documents as well, right? That's usually well.
Yeah, it depends. So I haven't had to sign one yet. We bring KPs to sign on the loan. and some other members of the GP have signed on the loan, because usually you need the net worth, the loan amount plus 10%, and it's been enough with the other partners in the GP side where I'm not needed to sign. Yeah.
And it's really crucial. I mean, because it's kind of faded a little bit now that interest rates have risen. But for several years, it was like everybody was getting into multifamily. But and there was all these syndications, and we've seen a couple, gone bad. But for the most part, it seems like people are having good experiences still. But it's crucial, right, about the GPs that you're working with, right? That the company and the the relationship, I guess, is important. So Ernie and I have invested as limited partners in several. That's what we do with a lot of our self-directed IRAs and all that. But a lot of it's been, for me, who do
you feel comfortable with?
Yeah, I've invested with people that I really
can trust.
Yeah, I've seen their track record. I've seen what they produce, and that matters, for us. And we've had really good experiences. But can you speak to that about who you're selecting and
Yeah, 100%. I think that's when you're looking to invest as a limited partner, you should start off with who do you trust more, and make sure you establish a relationship with that person, with the main sponsor on that deal, prior to investing, or even like, I'm not the main sponsor in all our deals, right? I raise funds under I don't do much co-GP anymore. I raise a fund, I create a fund, and then I invest in that fund, right? So obviously, if you trust me, then I'll I take care of the rest, right? I make sure that we put the money where it needs to go. But trusting me or trusting the sponsor is the main thing on your list that you should check the box for, prior to looking at whatever equity multiple or cash on cash you're going to get on the deal. I had a guy call me the other day. He was looking to invest in our deal or another deal that had. Ours was like 2.07x multiple that we have projected. The other deal he was looking at was 2.13x equity multiple. And he got on a call with me, and he was like comparing the numbers and all that. And I said, don't worry about numbers. Who do you trust more? I don't care if you say me or not. Like, just ask which person do you trust the most? Which market do you like the best? Which market do you know better? And then choose it from there, right? Because most multifamily value add deals have pretty similar returns at the end of the day, right? They're all 2x equity multiple, 15% IRR, and they're all projections, right? They can all vary. So it's at the end of the day, trusting the sponsor and knowing that they're going to do the right things, but looking at their track record. And knowing that they're going to make the right decisions when challenges arise, those are the people you should go with. And every syndication, just like flying a plane, this may surprise you to know, but every flight that we do, and every flight that's in the air right now, there will be something that goes wrong in that flight. And but there's so many systems and checklists and processes in place to catch all of those mistakes that they never even turn to something that you will even notice, right? Because obviously you probably sit in the back of many planes, you never even notice that something went wrong, right? And the same thing with a multifamily property, right? You may know about the issue because obviously you probably get notified or send an email,
right?
Hey, this happened, but don't worry about it. We're taking care of it, right? So issues will arise, is almost a guarantee, but you just want to make sure you trust the pilots to take care of whatever you need to take care of and take you to point A from point A to point B. Same thing with the syndication, right? You want to trust the guys at the front leading the syndication that they're going to do whatever they need to do.
If you have clients that are looking maybe to do syndications, like what questions would you ask, right? Or like how do you, or interview questions you should ask maybe a syndication to see if it's a right fit. What path would you take?
Yeah, I will ask them to tell me about their story, their background, to see how long they have been investing, how many cycle deals they have had. And I will be, contrary to popular belief, I want to see that they have had some deals maybe not go as planned. Because I want to see that they learn some lessons. Because when somebody has gone through, especially in this current past 10 years that we have gone through a very bullish market,
right?
Even the bad people can seem like real winners in or great investors because you virtually have to do not much to a property and you will still have a profit, right?
Right.
And if I see somebody that had a deal go wrong, it shows me that the other successes were not just by luck, right? It can point out to me that they had deals where they made the wrong decisions and they learned what not to do, and it can highlight the right decisions that they did make on the other deals that went right. Now, I'm not saying you shouldn't invest with someone just because they haven't had a deal go wrong, right? I'm just,
they've got the experience. They've been through it, right? Yeah.
And to me, it's like so we have a thing in flying, right? But whenever you see an accident, when a plane crashes, and you go back and study the history of everything that went along on that flight, there's this concept that we call the Swiss cheese model, right? And all the holes of the cheese line up for that accident to occur, right? And it starts with the crew not doing one thing, and that one thing led to another thing, and that other thing led to another. Right? It was never just one thing that went wrong, and all of a sudden it crashes, right? It was a series of things that led to the crash. And same thing in real estate, right? I'm sure you guys heard about the guy in Houston who recently lost about $225 million.
Correct.
And that's it, right? And if you go back and look at at the entire deal and how it was put together, it was the perfect storm with not just one thing that probably was very aggressive, but it was several things, right? High leverage, no interest rate cap on an adjustable rate loan, Class C properties in not the best neighborhoods. The guy didn't have the operational knowledge to grow to that scale, to that volume that he did in such a short period of time. And obviously it resulted in a bad outcome, right?
Correct.
And so just, I'm just throwing that out there for people to know that you can't just pinpoint to one thing and say this guy will be good because he did X or he did Y, right? It's always a mixture of things that make a good sponsor a good sponsor. So just getting to know them and trusting them and seeing how they make decisions will probably be the best bet on choosing someone.
Yeah. That's awesome.
I had a quick question. And I don't know if you've purchased like that middle. This is just a question because we have a lot of clients that I think struggle with this. So you were in single family, and a lot of people start there, and then they try to move up next into multifamily, but they usually try to do it like themselves, and they're usually not all the case, but they don't want to raise money and to me, I don't know why they don't get together as a group sometimes, but so they'll take down a smaller complex, right? Let's say 30 to 60 units, right? To take to take that next step up. And then before they maybe want to take that next step into the 100 to 200 and raise money and become and maybe they're gaining experience, but I think that 30 to 60 door count, even if you're the individual investor and it's tough, right? So I don't know if you've taken those steps, with your fund and in the past, but like, I'm looking for your experience and what you maybe some insight on if they are moving from, should they just go from, I think to me, it'd be a better, like they'd be safer with their money if they went from, the single family and then just maybe became a limited partner in a much larger deal and gain the experience there and learn, because you can learn a lot as a limited partner. You can see all the steps that the GP is doing and learn from them. And maybe take more of an active role, but depending on how much you invest. But I know they can't call the shots, but at least
learn from that experience.
And then grow. I don't know. Just what's your 2 cents on that and take on it?
Yeah, dude, it's funny you mentioned that. I see guys that get stuck on that 30 to 60 unit count apartment complex, and I'm like, why? Like, just go to the big ones, right?
Yeah.
But I think it goes back to what you want to do and your goals. I've talked, and I think this is why I believe some of them stay there. And so I actually, this guy took me out to lunch to ask me this exact same question, right? To wanting to know whether he should continue doing like the 12 unit, 24 unit, or just go pretty big, right? And I told him that he could go very big right away, and start doing maybe LP, like we just mentioned, raise some capital, and then eventually lead into becoming the main operator, right? The biggest hurdle or barrier to going 100 unit plus is the track record, right? They're not going to award you the deal that big because you haven't done one that big, right? But if you get involved with other groups and you can show that, hey, I was involved in these syndications as on the GP doing, whatever it is that you were doing, then obviously you can count that towards your track record, right? But
correct.
If you get stuck in the 30, 40 unit, you will never get to that 200 unit track record apartment complex, right? But what I've seen most guys want to stay in those smaller unit range is because they want to own a bigger piece of the apartment complex. So that's
so it's a control issue.
yeah. So that's why they want it, right?
And I actually see, because we obviously are in property management, so we deal with a lot of investors, and I think it's that a lot of it is the control.
So because when I tell them like how the syndications are structured and what they're going to own of the bigger property, they're like, oh, no, I don't want to give that much away. And I'm like, okay, I mean, it's your choice, right? There's obviously more to win,
yes.
But it's totally up to them, right?
Yeah, that's awesome.
So I had a question for you too, going back a little bit in your story, but just curious, because I know we have a lot of people that listen that, they might be professionals or they, have a maybe a corporate career, but they're investing in real estate. How do you recommend them balancing, and I understand pilots maybe have a little bit more freedom than some other careers out there, but, how did you balance your real estate, ventures and all that with your pilot career?
Yeah, I would say stop trying to balance it. It's hard for sure. It's definitely hard. So I think the best way to go back and do that is to, one, get a coach or a mentor and somebody that has done what you're going to do, because you will not believe how much time I wasted when I first started thinking that I could do it myself. I don't have to spend the $5,000, $10,000 on somebody to show me how to get there faster. I can do it on my own. That's the story I told myself. And I spent so much time and trial and error to only end up paying a coach so that he can show me how to do it. Right. So that would be, and this is coming from a guy that doesn't have a course. I don't teach anything. Right. So I'm not biased telling you get a coach, and really figure out. So like once you get a coach, figure out what are the steps you need to take and put that plan together so that you're going to have to make some sacrifices, right? You can't live the lifestyle you were living before with all the free time you were having, and then all of a sudden try to squeeze in building a business or some other adventure, right? Something has to be given up at somewhere along the way for you to accomplish something else, right? And whether that's like the 2 hours of TV you were watching every single night, maybe instead of watching 2 hours every single night, you're going to be putting the steps towards the plan you put together to achieve the next milestone in your business, right? That's my biggest recommendation, to do that and not waste time and just get there faster. And if you have a family, I think it's harder, right? When you have 5 kids. So really bring everyone together and like share that why of why you want to do this, because at the end of the day, your family is either going to be cheering for you or they're going to hate that you're gone for those 2 hours every single night doing something that they don't understand why you're doing it, right? And so if you can share that goal and everybody is on the same mindset, then they're going to be cheering for you, ensuring that you're going to do the things you need to do, and they're not going to be placing any blame on you or feeling resentful because you're in there, right, for the first couple months or however long it takes to achieve your goal.
That's a great answer.
Love it. Yeah. So now let's talk a little bit about the freedom aspect of it. So tell us how you gain freedom of your time and why it's important to you. And now that you've gained that, how do you not like chase shiny objects or be complacent? Talk a little bit about that.
Yeah, that's a great question. I think the time freedom for me is super important because and we're in the same group with Steve, right? And so he's shown me many things how family is the most important, right? And there was a period of time when I was building the business that I neglected my family for for some period of time because I was so obsessed with driving revenue and closing more deals and more money. And then when you sit back and think about it, you're like, why am I even doing this? Right? There's no point. I read this book, a pretty great book. It's called The Psychology of Money. And it just, one of the chapters there that really made me think deeply about this is it starts comparing all of the different levels in net worth and in income from all kinds of people, going from like a guy that is a rookie baseball player making $500,000 a year to Jeff Bezos. By the time that this book was written, Jeff Bezos was the richest highest net worth in the world, right? And it just compares everybody in between and how trying to strive for being the number one is a dumb goal.
Yeah,
there's always going to be a higher ceiling if you compare yourself to someone else. And obviously, the book also talks about like doesn't want to portray that you shouldn't reach for your potential, but you should establish what your goal is and not be comparing. Once you get there, don't keep moving that post, right? Because most people are moving that post, and you get there, and then you're constantly living in this stage of I'm not going to be happy until, right? And you keep moving that post on your next goal. So for me, it was that, right? I established what my goal is. I want this to be my lifestyle. And I'm okay with doing these activities that I'm currently doing for my life. And I'm extremely happy and satisfied being an airline pilot, running the private equity firm. I have no desire to have a 100 employee company, right? I want to keep it lean, and I want to enjoy a lot of our free time and experiences and activities go on our calendar first, and then everything else.
Right.
Same reason why I have no desire to be an operator, a multifamily operator. Those guys, I mean, they're putting in the work, right?
They are.
They're doing a lot of things. I'm perfectly happy for them to make 2/3 or more of the GP because they're the ones putting in their work, right? I'll take the third or less of the GP by bringing funds, and because obviously I have more time freedom than they do, right?
Yeah.
And so it's just a really establishing and thinking about your life and what is it that you want to do for yourself, and figure out what are the games that you want to play, right? I divide life into different games, right? I have the business game, or like the business money game, the family game, the relationship game, right? And establishing what's the goal that I want in these different games.
In each bucket, yeah.
Each bucket, right? And then just be happy with getting there and stop comparing yourself to other people when you get there.
Yeah, love it. Satch, if you can go back in your early 20s, what advice would you give yourself?
Oh man, I was pretty wild back then. I think I'll go back and if there's just one thing I could tell myself when I was that young, is to give myself that Rich Dad Poor Dad book and have myself read it. I think that would have changed my life trajectory at such an early age. I didn't read that book until I was 25, and it completely my life went in a different direction. So where I thought it was going to go versus where it actually went because of that book. So if I would have read that book, and who knows, right? Maybe you know how they say that the teacher appears when the student is ready, right?
Yeah.
Maybe I could have read it when I was 20 and I would have just thrown away. I don't know.
Right.
I would like to say I want to give that a chance in my early 20s.
Yeah, that's awesome. So, Satch, the next question we asked actually all of our guests on this show. So, what's your next? What are you looking to accomplish in maybe the next 5 to 10 years?
Yeah. So for the next 5 to 10 years, I for sure want to take a 1-week vacation with my family every single quarter. That's a definite goal. That's not going anywhere, right? That's my non-negotiable. Yeah. And I want us to experience a new country every single time. And for business goals, I want to stay within the fund management space, and I want to continue raising the capital that we raise every single year by 50%.
Awesome.
Once I get the mark, then I'll probably amend the goals or maybe continue down that path.
Yes. Awesome. Well, if we have guests on the show that want to get a hold of you and maybe learn more about your syndications or, how they can invest with you, how can they get a hold of you?
Yeah, the best way is to reach out to me in social media. I'm on every social media out there, and just my name is pretty unique. So you will find me, Satch Bernhardt. And aside from that, my website is V1, the letter V as in Victor, number 1, cap.com.
Cool. And we got all your information, so we're going to put that in the show notes as well, so people can hopefully connect with you and learn more about your fund and some of your deals that you're raising money for. So hopefully that can help you, get you that 50% growth that you're looking for.
Yeah. You have a cool story. I'm actually really excited for this show, and our listeners are going to be excited as well.
Yeah. So thank you for joining us. If there's anything we can ever do to help support you, but we'll definitely promote the show and put all your info so people can reach out. But thanks again for being here today.
Thank you so much.
Yeah. And everybody, we'll see you all next week.
See ya.
You've been listening to Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkel. Tons of entrepreneurial podcasts are out there. Talking. But Joni and Shawn are living it every single day. Their portfolio now includes many franchises and medium-sized businesses. We talk about the trials and motivators of successfully running a business. Join us again soon for another podcast. But until then, reach out on the website at InsideTheWolfsDen.com, on Facebook at Inside the Wolf's Den, on Instagram at Inside the Wolf Den. We'll see you again soon. This is Inside the Wolf's Den. We'll see you next time.